This is video 5 in our review of financial calculations called Return of Investment, or ROI. I'm Dr. James Renaud from Shawnee State University, and I'll be taking you through this very brief video review. Return on investment is a very simple calculation to calculate what your return on an investment would be. That kind of makes sense by the name return on investment. It's used to compare options. If you have an investment that has an ROI of this and an investment with an ROI of that, the one with the higher ROI might be better. It's not always better because return on investment does not take into account the length of the investment. If the investment is a 30-day investment or a 30-year investment with the same ROI, the 30-year investment doesn't take into account the time value of money or the discount factor of money. So ROI is a simple calculation for simple things. Basically, the return on investment is the net income divided by the expense. Now, in the formula here, it says it's the gross income minus the expense divided by the expense. So it's the net income. You may have problems worded with your net income will increase by this for this expense, or your gross income is this. So if it's gross income, you have to subtract expense from the top of the equation. So it's a simple ratio. ROI, it's often expressed as a percent. So if you get an ROI of 0.10, that would be a 10% return on investment. Let's look at a couple of quick examples. So let's take a look at our first example. You spend $1,000 on a new tool. You've invested in something that increases sales by $1,500. Well, sales is gross income. Correct, because you've got to take your cost of goods sold out of sales. The tool cost you $1,000, so our net profit or our net increase would be $500 divided by 1,000 would be 0.5 or 50%. So to spend $1,000 on a tool that increases your sales by $1,500 of new sales, that's a no-brainer, right? You invest $1, get $1.50 back. It's a great investment. Return on investment, ROI. Let's look at another simple return on investment example. Your net profit increases $125,000 after the $500,000 upgrade to your system. Well, we're not talking gross profit here. It said net profit. So net profit would be an increase after the expense. So we don't need to subtract the expense a second time. It's already been subtracted because the problem said net profit. Be very careful when you're reading a return on investment problem as to whether you're given the gross receipts or the gross or the net. And so the ROI would be 125 divided by 500 or 0.25 or a 25% return on investment. If that investment return is pretty quick in the round of a year or two, that's probably a great return on investment. If it took you 10 years to increase your profits $125,000 over that time period, I don't know. That's a problem that we need to look at with time value of money and the net cost of cash, net cash flow, and those types of calculations. This concludes my brief summary on, or brief review of return on investment. Thank you for watching this. Please see the entire financial calculations review that I'm posting out here on YouTube. If you like it, subscribe or give it a thumbs up. I'd really appreciate it. And if you need to contact me with any questions or errors, do that at jrenaud@shawnee.edu. Again, thank you for watching, and I hope to see you on other videos.